Now, so this is mainly just for financial businesses, and we were going to talk a little bit about trading businesses also.
So yeah, so I would say this is certainly relevant with respect to the financial services industry. If we were going to put it in the context of a hedge fund or a private equity fund, this certainly has to do with any excess losses for entities that are engaged in a trader business. The concept of a trader business really has to do with, in the world of hedge funds, has to do with traders versus investors. And we're going to talk a little bit more about what differentiates a trader for an investor, and certainly what mechanisms exist for us to provide us with benefits in connection with the current environment.
Yeah, and there is a lot of confusion about whether someone is a trader or an investor, and the tax laws treat them very differently. So that's a big consideration if you're especially somewhere in between that trading and investing category.
So certainly that's absolutely right. The concept of trader versus investor, it can be very vague, because of course it's not specifically the rules around it are not specifically defined. It can be very much a qualitative as well as a quantitative analysis. So before we get into that, perhaps let's touch on the changes to the investment interest expense rules, because I think that's going to segue well into what it means for traders. So with respect to that, I think that the investment interest expense rules have likewise been affected by the CARES Act, and it is largely a function of what used to be before the Tax Cuts and Jobs Act and what exists now. So in connection with the CARES Act, in connection with the Tax Cuts and Jobs Act, there is now a limitation on the amount of interest expense that can be deducted. So conceptually, this was implemented in an attempt to equalize the tax treatment of debt versus equity financing, right? When a corporation wants to raise money, it can do it a couple of ways. It can issue equity or it can issue debt. They're both accounted for very differently for tax purposes. Namely, a dividend paid in connection with equity is not deductible, whereas the interest paid in connection with the debt instrument is deductible generally. So what the Tax Cuts and Jobs Act did was it created a limitation on the amount of interest expense that can be deducted in a current year. So essentially, assume in 2019 that a partnership had taxable income, we'll just say generally taxable income of $100, which included $100 of business interest expense. Well, the partnership would only be able to deduct $30 of interest, and the other $70 would be considered excess business interest expense. That $70 in excess business interest expense carries forward at the partner level, again, the beneficial owner level, on the next year return, and in this example, the 2020 return. And so that can then be used only if there is additional income that doesn't limit the 2020 interest expense.
I had a question before you start.
Yeah.
I know that hedge funds, tend to carry, a lot of leverage, which means they're borrowing a lot of money. So I imagine that this limitation on the deduction of interest, was that a big impact for them?
So the answer is it could be. In a typical credit fund, you would expect, and that's what we've certainly seen in previous years, you would expect interest income to exceed your interest expense. If that's going to always be the case, then you're not as likely to run into this. That said, for many different strategies, including private equity strategies, there absolutely could be an effect here, and it's something that everyone needs to look at very carefully when when looking at their income taxes from an estimate standpoint.
Yeah, definitely private equity, where you're financing what, 65% or so of the acquisition with debt, that would be a place where, and you're probably paying a higher interest rate because it's a more kind of risky, it's leverage lending. So it'd be a more risky loan. So you'd be paying more interest and have a bigger interest bill, even with today's interest rates.
So that's right. That's right. And so this is one of the things from the Tax Cuts and Jobs Act that was extremely relevant to the hedge fund industry.
Yeah.
So what the CARES Act has done is it has relaxed that somewhat. Under this new law, there would be no change in 2019 to the interest deduction allowed for a partnership. The result would still be a 30% interest deduction, again, using the same numbers, a 30% interest deduction and a 70% excess business interest expense. However, in 2020 now, the partners would be able to deduct 50% of the 2019 excess business interest expense carry forward. So in this case, that would be $35. And that would be without respect to the 163J limitation. And then the remaining 50% would still be subject to the existing rules. So, what we can see here is that while it hasn't been eliminated, it's certainly been largely relaxed.
Interesting. Okay.
So this is probably a good time to get back to your question from earlier with respect to trader versus investor. When making a determination as to whether an individual or an entity is a trader or an investor, the relevant considerations really have to do with the deductibility of expenses. So to the extent that you are an individual or you are managing an entity trading for its own account, you need to on an annual basis make a determination as to whether you are a trader or an investor. We can get into that in a minute. To the extent that you are a trader, you will be able to deduct a lot of your expenses. So what expenses do I mean by that? I mean professional fees. I mean, what's very important to investors, management fees, and of course, depending how you're structured, potentially your performance or incentive fees as well. Investor funds largely are not allowed to deduct those expenses regardless. So clearly, I think we see that it makes a big difference as to whether you determine to be a trader or an investor. So what I usually tell people is that it's just as much a qualitative analysis as it is a quantitative analysis. There are quantitative mechanisms to utilize in order to make this decision, or at least to gain confidence in whatever your ultimate decision is. Namely, you can look at portfolio turnover. You can look at just plain trading activity. On the qualitative side, you look more to whether you're running your business as a true business. Somebody working out of their home, which a lot more people are doing these days, need to be very careful about how they are accounting for their business. And again, just if they're generally running the business as a business. So once a determination is made for trader versus investor, one thing that I think bears mentioning, particularly in this environment, is the potential for the 475F election. So clearly there's been a lot of volatility in 2020, and traders may find themselves in a situation where they've got significant losses in the tax year. So one thing they can avail themselves of is this 475F election. So 475F is really an election into a new accounting method on how you treat your securities and or commodities within your portfolio for tax purposes. It provides for mark-to-market accounting, and it changes the character of all your income and loss to ordinary. So just to take a step back from that for a minute, mark-to-market accounting is when the trader treats all of his or her positions as if they are sold on the last day of the year. So whatever the market is, then that is a deemed realization. So that would eliminate all unrealized. It also eliminates a lot of tax adjustment regimes, which can be very problematic when it comes to the way that it affects the recognition of losses, namely wash sales, straddles, those sorts of things. So it also, so 475F also converts, again, all of your gains or losses to ordinary. So what that means is they will not be capital in nature. They will be subject to the highest rate. That said, in a year when you're down, it's preferable to have losses. So, again, without this mark-to-market, securities traders could be in a situation where they could be looking at a capital loss limitation, right? We all know that at the individual level, we are limited to $3,000 of capital losses. That amount, any amount that we have in excess of that, will carry forward indefinitely, but it's capped at $3,000. And for high net worth individuals, a $3,000 cap could mean that they are, carrying forward stuff longer than they're going to be able to ever use. So anyway, so all that said, it's really important to recognize the benefits and the drawbacks from the 475F. Clearly we can see the benefit in a down year, but in an up year, to have to let your investors know that even though a position may have been held long term, that they're not going to get long term treatment, can be problematic. I think that one of the benefits is when it comes time to do tax estimates, well, it's pretty easy to know what your taxable income is because your book income equals your taxable income. So that can eliminate any sort of confusion that can exist there. So there's any number of ways we can look at this, and you need to wear the lens of where you are this year, and of course where you might be in the future.
That certainly is a fairly complex decision, and there's probably no general advice you can give traders or investors concerning that, but it is an important factor because I know certainly individual investors, like you said, are very limited by that $3,000 deduction, especially in years like this. So very interesting.
Yeah, it can certainly make for an uncomfortable conversation when there's when a fund encounters a bad year economically, and then to pile on top of that, the investor now can't even utilize the benefit on his or her individual return.
Yeah. All right. So any other areas that you think would be important considerations for investors or traders, or any financial business advice that you're giving aside from what you've already given so far?
Well, I mean, that's certainly a big question. I would say that what I always say is taxpayers are like snowflakes, right? That no two are ever alike. So everybody's got their own considerations, and everyone has their own really fact specific circumstances. So look, while the answer is almost certainly yes, to attempt to really cover any additional points and do them any justice in this kind of format will be tough. But I'm certainly certainly be happy to entertain any additional questions.
Yeah, I mean, the only thing that I was thinking about is, as you said, there's a lot of contention in terms of implementing some of the assistance plans like the Paycheck Protection and so on. And then there's also contention about any kind of tax changes. And I guess investors and traders and just financial business in general are looking into an election year now and possible changes and possibly legislation that is designed to appeal to an electorate also, that may come before the election. So you might see possibly some more legislation out there as people run for office and so on. So, yeah, very interesting. Yeah, go
Yeah,
ahead.
it's certainly, we're getting a little bit of a sense from the Republican side now that, any additional legislation is going to include protections for businesses.
Yeah.
So, we can see that the direction they're moving in is increasingly business friendly.
Right. All right, very good. Well, that's quite a comprehensive view of business taxation and COVID. And I really didn't have any more questions besides that. Did you want to close with anything?
No, I mean, I think that my sentiments are pretty clear, just based upon the conversation that we've had. We're living in extremely interesting times, not only from a personal perspective, but obviously from an economic perspective, where's the economy going to be in a few months, but also obviously from a legislative perspective. And legislation can get passed in a hurry, in a meaningful way initially, but it's only when we are able to parse it out and view it wearing the lens of real impact on real people. Do we know how helpful or detrimental it can be?
Yeah, we probably won't have a clear picture until maybe next year, after the election, and after we hope the economy and the markets have settled down a little bit by then. But very interesting. Anyway,
Yeah.
thank you, Paul. I've enjoyed listening to you and hearing you talk about these business taxation issues. And I want to thank you for taking the time to share your knowledge and your experience, in this area with the people who will be watching this presentation. So anyway, thank you very much. I've enjoyed talking to you, and
Thanks, Jack. Likewise, for sure. Certainly looking forward to providing any additional information as it comes up, or providing updates as things change.